Hello, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Monday, November 12th. I am recording a little bit early because I am traveling, and you are, of course, tuned into On Trend, the show designed to keep you on the right side of the trend. And today we're going to talk about weekly breadth indicators. We're going to look at some weekly advances with some big ranges. We'll look at a failure in a key retracement zone. We'll show you how to measure the appetite for risk. And then we'll see what's down with Goldman Sachs and finish with the Bloomberg commodity indexes. All right, let's start with charting the weekly breadth indicators to look at some long-term signals. So StockCharts has a number of breadth indicators that are based on weekly data. And what that means is the change from one week to the next. So for instance, we have NYSE issues advancing weekly, the number of issues that closed higher on a week-by-week basis. And last week we had 1,919 issues closing higher. On the declining side, we had 1,181 issues closing lower. So these are kind of longer term indicators, and we can use these as well to create AD lines. We also have these indicators for new highs and new lows, and we can get some longer term oriented breadth signals from these indicators. So what I did here is I did a Google search for Barron's weekly advances, and these come from the Markets Data Center table at Barron's. And if you click on that link, you'll see at the top there is a link for weekly totals. And you click on that link, and there you'll see NYSE issues traded, advances 1,919, declines 1,181, has new highs and new lows, and it has these indicators for the NASDAQ as well. All right, so this first indicator group that I've got here is the number of net advancing issues weekly, and that is $NYAD weekly, divided by the number of total issues on the NYSE weekly. And I've got a horizontal line at plus 50% and one at minus 50%. And so basically when you get moves below minus 50%, as we did in March there, you can see that's a negative. And if we get moves above plus 50%, that's a net positive. We didn't get one in the NASDAQ there. And you can see here that we got some moves below minus 50% in October there. So these indicators, as far as I'm concerned, the last signals that we have were these moves below minus 50%, and they are bearish signals until proven otherwise. And I would like to see both of them move above plus 50% to suggest we've had a weekly upside breadth surge to warrant turning possibly bullish again. Now here's this same indicator group, and what I've got is the indicator you just saw in that second window, and in the lower or the third window I've got the weekly AD line for the NYSE, and in the top window I've got the S&P 500 equal weight index, because it's kind of the closest we can get for a hybrid between the NASDAQ and the NYSE. I could show the NYSE and NASDAQ, because really if you're looking at the NYSE AD line, you should compare it with the NYSE. You shouldn't look at the S&P 500 and compare it to the NYSE AD line, because the S&P 500 has like 1/3 of its components, I think, come from the NASDAQ. So you're leaving out a big portion of the S&P 500 if you just look at NYSE breadth or NASDAQ breadth for that matter. But you can see here basically range bound on the S&P 500 equal weight index, and then we look at the AD line and it was range bound, but it's moved below that low in February, March there, and so it's trending lower, it looks like, and that's a negative. And then when we look at the NASDAQ, we can see that that AD line did hit a new high in late August, but then really fell sharply and broke below that low. So this AD line is also trending lower. Now the next indicator group would be new highs and new lows. And so what I've done here is you can see that I've got new highs in that first window with new lows in red. And there you can see we had that big expansion of new lows in October. And then I've got the high-low percent indicators below with a horizontal line at plus 10% and one at minus 10%. And you can see this line moved above plus 10% back there in March 2016. And it did not move below minus 10% until January 2018. And it didn't get back above plus 10% in the meantime, and it went back below minus 10% in early October. So this indicator's on a bearish signal, if you will. Now, if we look at the NASDAQ version here, and I'll go ahead and remove some of those annotations, make it clean for you. So there you can see new highs and new lows overall. And then you can see the high-low percent indicator, which is net new highs weekly divided by the total issues in the NASDAQ there. And we can see that we had a bullish signal in the summer, and we had a bearish signal in February. We did get a bullish signal there in early June, but we also got a bearish signal in October. So on balance, which is the way we always need to look at broad market analysis, we need to look at the positives and the negatives and see what weighs more. I think the negatives clearly weigh more, and with these being weekly indicators, I think that's a long-term negative for the broader market. Now let's look at some big advances and some big ranges. All right, so here we've got a chart of the S&P 500, and it is going back 4 years. And you can see during this 4-year period, we had basically a nowhere time in 2015, 2016, nowhere for 18 months. Now, prior to this sideways trading range, we had a huge advance in 2013 and 2014. So some sort of consolidation was normal. It lasted a bit longer, a bit deeper, a bit scarier than most people thought during this decline here in 2015, 2016. And then we took off and we had another move higher, a big leg up in 2017 especially. Now, we had a long consolidation at the beginning of 2018. That was after the advance kind of went parabolic there. And then you can see we broke out of that consolidation and moved to new highs. But now we've had a really sharp decline below the 40-week moving average. And we bounced back to that moving average, but we're already down a little bit on Monday here. And so we could be failing at that moving average. And you can kind of put a first line in the sand just above those highs in October, in mid-October there. But the point of this chart here is to show you that when you get big advances, you can expect big, long, drawn-out consolidations. That's pretty normal. All right. For the record, I turned bearish in mid-October, so I'm negative on U.S. stocks. Now, it could be, as I said, it could be a trading range type correction, or it could be a real pullback, where we retrace a good portion of this advance from 1800 to 2900. If you retrace just half of that, if you suggest that that was about a 1100 point advance and you take back 550 of it, well, you're going to go to around 2350 if my math is correct, and that could be a normal correction. On the indicator window, I've got the PPO 5260, which measures the difference between the 5-week EMA and the 26-week EMA. It's a little bit more sensitive than the usual 1040 combination, and you can see that it's been bullish since March 2016, and it is now bearish because it turned negative over the last 4 to 5 weeks. So when I look at this chart, I see more negatives than positives, and that's why I'm net negative on the U.S. market. We look at the S&P 500 equal weight index. Now, I'm not a big fan of double tops, but you can see two highs in that 4,400 area and intermittent low kind of. It's really a big consolidation, but we've already broken down. We've already broken the 40-week moving average, and we can see that PPO is already negative. So, if you break support here at 38.50, that's just continuing what has already happened. All right, so that's why I think that pattern is pretty much a non-event for me, because I'm already bearish on the market. When we look at two more indexes, we'll look at the NASDAQ 100. We can see that it is broken below its 40-week moving average there. So that's negative, and the PPO is negative. And you can see if it retraces just half of that big advance, it would go back to this, 5,800 area. And then if we look at the Russell 2000, it's even weaker. Look how far below its 40-week moving average it is. All right, had this little bounce 3 weeks ago, but now it's already looking like it's failing. But, that's neither here nor there, because the PPO is negative and you're below the 40-week moving average. So all in all, the net evidence remains bearish. All right, now we're going to get a little bit more granular and look at the daily charts and show you some failures at some key retracement zones. All right, so here is the S&P 500, and we can see that we have this a big decline that broke everything down in October. You become way oversold, and you get this counter trend bounce. We had the gap before the election, then we had the gap after the election, and the move back above the 200-day. And you can see we've just now filled that gap that happened after the election. And look where we failed. Right in that 50 to 62% retracement zone. So basically, everything is running to script. If you had to script out an oversold bounce, as I did last week, I would script it to fail in that 61% area, the 50 to 62% area. And you can see we're back below the 200-day. We filled the gap. And so at best, I think we're moving into some sort of a choppy trading range. And at worst, I think we're continuing lower. It's just no market to be bullish right now. If we look at the NASDAQ 100, it is faring even worse. All right, you can see that it had the move back above the 200-day, but it failed miserably with a very sharp decline the last 2 days. And so basically, the market has lost its leadership from the NASDAQ 100, and it's failing in that 50 to 62% zone as well. Now, if we look at mid caps, they're even weaker. You can see that they didn't get above that 50% retracement. You can see the 50-day EMA, the 50-day moving average is just above the 200-day. There you can see the numbers on the left there. So we almost have a death cross working for mid caps, so they're much weaker than large caps. And if we look at the small cap 600 index, we can see that didn't make it up, didn't even touch the 50%, didn't make it above the 200-day. So this is much weaker as well than the broader market. That 50 days coming down hard and is set for a date with the 200-day, and we'll probably get a cross there. But the bottom line is small caps and mid caps are weaker, and S&P 500 and NASDAQ 100 don't look good either. Now I'm going to show you some ways to measure the appetite for risk, and clearly the appetite for risk is not very strong. Now, before I look at these ratio charts to show you the risk environment right now, I want to show you the PowerShares High Beta ETF, or High Beta, depending on where you are. But I did a little Google search for PowerShares High Beta, and there you can see you want to take the link from Invesco, which is the ETF provider. You want to go straight to the source if you can. And if you click on that, you can get the details on what is in this high beta ETF. It'll show you the description. So basically, it's taking the top 100 stocks in the S&P 500 that have the highest sensitivity to market movements or beta over the last 12 months. All right, so it's looking for the higher risk plays, the more volatile plays, the momentum plays. And then I'm going to compare that to a high quality ETF and a low volatility ETF. I'm also going to use the iShares Momentum Factor ETF as well, and you can go to the iShares website, or you can just Google iShares Momentum Factor ETF to find out more on that one. But the gist of this is we are measuring momentum versus volatility, momentum versus high quality. So the rationale for doing these ratio charts is that in a bull market, you should see momentum outperforming low volatility. So you're in low volatility when you want to shun risk. So here I've got the iShares Momentum Factor ETF in the top window. In the middle window, I've got the iShares Minimum Volatility ETF. And you can see when you plot them together, they were both rising here from February until September. And so you couldn't get too much information out of their actual price charts, except now you can see here the Momentum ETF failed at that October high, whereas the Minimum Volatility ETF, which has lower risk, actually exceeded that October high. But really where we get the real information is when we plot them as a ratio. So this ratio, momentum is outperforming when this ratio rises. It's the MTUM USMV ratio, and you can see it was rising there from January until around May, and you can see it's pretty much been declining since June, and it took that big hit there in October. So clearly momentum is not in favor right now. That means the higher risk plays in the market are not in favor, and participants are preferring low volatility or less risk. Now, if I scroll down here, you can see how I created this chart. I did price, and then I did the symbol, colon, and the other symbol to get the ratio chart. Now we got two more here to show you, and these are the ones from PowerShares. We have the high beta versus high quality ETF, and I like to keep them in the same fund family when comparing, because then you know that the way their construction is similar. Like I compare iShares to an iShares ETF or a PowerShares ETF to another PowerShares ETF instead of crisscrossing. You can see here's the high beta ETF, and it's just gone nowhere all year. Okay, it kind of looks like a flat trading range like we saw on the S&P 500 1500 index before, and it broke down here. So it broke to that's basically a new low for 2018, so that's not a good looking chart. We look at the high quality ETF, you can see it got above that high in August, September, so it hit a new high. So it was outperforming the high beta ETF. And it got hit as well, but it's still above that 2018 low. So it hasn't gotten hit as much. And again, the most information comes out of this ratio. Okay, here high beta's outperforming all the way until the summer, and then it starts underperforming, and look at that plunge in October. So right now, high beta is underperforming high quality. That means the market is being very selective. It prefers quality, and that is not a good sign for a bull market. All right, it tells you that you want to be shunning risk. And the last chart, you look at all three, see if they jive. This is the high beta versus the low volatility ETF, and you can see that ratio chart started breaking down in August and had the big breakdown in October. So basically, it is a risk-off environment within the stock market. And just a friendly reminder, if you have any questions, comments, or feedback, you can always send an email to askarthur@stockcharts.com. I cannot promise to answer all of them, but I will read them and take them into consideration. This is a question I've gotten fairly often. What happens to your mean reversion strategy when the market turns bearish? So the mean reversion trading system first only trades long when the 5-day moving average for the S&P 500 is above the 200-day moving average, simple moving averages. And it was for all of 2017 and most of 2018. And then you had a cross here in October on the 23rd here, I believe, for the S&P 500. And so once that happened, the system technically stops taking signals. And then, of course, in mid-October, the breadth indicators turned bearish. But in between these two, we had a bullish signal there on October 15th when RSI moved above 30. So the question is, do you take that or not? Well, I didn't back test the system based on the breadth indicators. I back tested it based on the 5-day and 200-day crossover for the S&P 500. So technically, this was still a valid signal. And then you can see the S&P 500 moved above the chandelier exit there and back below. So we got a close in that position over the last couple of days, and it would have been a losing position. But the bottom line is basically this mean reversion system has stopped working. Buy the dip has stopped working. It worked great in 2017 and for most of 2018, but now it has stopped working. So we need to start looking for exits. And you remember, technical analysis is part art and part science. There's a subjective aspect to it. So you look at the QQQ here. Okay, it got a bullish signal there in mid-October, but then promptly fell. And then it surged, but didn't close above the chandelier. So we didn't get technically an exit signal, and now we're turning back down. And the problem is we're in a broader bearish market environment, I think, and that's why we need to be looking for exits on our systems that have stopped working. Now, one thing I'll do a close-up on that QQQ here. There you can see, we had this nice bounce, and we got up to the chandelier and actually touched it intraday and then fell back. And it's been a pretty good failure there, and I would think that the markets are going to move below those October lows. What is up, or rather down, with the big banks? So in Don't Ignore This Chart today, I featured Goldman Sachs because Goldman Sachs is, of course, the premier investment bank out there. And if you look at this chart, it is not a pretty chart, all right? It is clearly a long-term downtrend. And we can see here that, when the market was moving to new highs in August, September, Goldman Sachs didn't even get above its 40-week moving average. And so if things are not very good for Goldman Sachs, and if you look at Citigroup and Bank of America, those charts don't look good either. So you can see Goldman Sachs, back to the chart here, broke below that 40-week moving average and then had this little bounce and has now moved back down and is now at a new low for 2018. And so this is one of the bigger stocks in the finance sector. It's also one of the bigger stocks in the Dow because it's over $200 a share. And it is one of the big stocks in the broker-dealer iShares. And if you look at the PPO there, 526.0, it's been in negative territory since April. So, and here's how long Goldman Sachs has been underperforming the S&P 500 for almost 2 years. And so the finance sector is still a big sector. And when one of your leading investment banks is underperforming, that tells you the market is not working right. Something is not quite right there, and we've seen breakdowns in October, and so we need to listen to the message from the market, and it is not bullish. And now I just want to show you how you can track commodities using the Bloomberg commodity indexes. All right, so first, when I wanted to know about the Bloomberg commodity indexes, I went to my good friend Google and I searched Bloomberg commodity index. And there you can see some links to Bloomberg. Again, you want to go to the actual Bloomberg site to find out what commodities are in these indexes and how they're weighted. And Bloomberg has a really nice article. It's from October 2017. It was for the 2018 target weights. Maybe there's another one that's newer. I couldn't find it. But what I like about the Bloomberg Commodity Index is it's a lot broader than, say, the CRB index. Energy accounts for like 30% of this commodity ETF. And there you can see the energy components: natural gas, Brent, WTI, gasoline, and diesel even. Then we got the grains. And then you can see industrial metals: copper, aluminum, zinc, and nickel, only 4. 2 precious metals, gold and silver. And 3 softs: sugar, coffee, and cotton, and livestock: live cattle and lean hogs. So now that you know what is in this, you can understand what's moving them better. So here's the broader Bloomberg Commodity Index that you can see here, and it of course has all the commodities I just showed you there. And this is not a bullish chart. This chart is not on trend. All right, we can see that it has been pretty much flat for most of 2016, 17, and 18. And in 2018, it has started moving lower. It's below the 40-week moving average. And you can see the PPO 526.0 is negative there. So broadly speaking, commodities are not looking bullish. Then we can break it down and we can look at the separate components here. We got the energy components, and we can see the energy is still in an uptrend, but it's at a moment of truth. We've had this really hard decline, sharpest decline since we had since January, February. And with the stock market turning risk off, I would think that oil would not be a preferred vehicle as well, or energy. But you can see we're right near these lows from the summer. We're right at the 40-week moving average. And if we break down further and that PPO turns negative, that would obviously be a negative development for the Bloomberg Energy Index. Then we look at grains. I mean, look at this downtrend here. All right. Don't even say that there's a base working there. Okay, yeah, maybe there's support and maybe we're going to bounce, but is it on trend? No. Is it in an uptrend? No. So it's something you just pass and move elsewhere. And look at that negative PPO. All right. Maybe if it bounces above 32, you get an oversold bounce. But right now, corn, soybeans, and wheat as a trio are in a long-term downtrend. Then we look at industrial metals. Okay, this is a good litmus test for, say, the global economy, if you will. You want to see industrial metals moving higher. This is aluminum, copper, and zinc, and nickel. And they were moving higher in 2016 and 17 and the beginning of 2018. And that's when the bull market in stocks was going. But we can see that industrial metals have broken down here in the summer of 2018 below the 40-week moving average, below that spring low, and almost at a new low, or a new 52-week low almost. And the PPO is very negative. So this is clearly a negative here, that industrial metals are not moving higher. So that suggests global demand is not strong for industrial metals. Then we look at livestock. I don't have any correlations for the stock market with livestock here, other than to say, it's probably been trending down since 2017. Had a counter trend bounce here. I wouldn't even know how to play live cattle or lean hogs anyway. But it's just, it's part of the group that we have to take a look at once in a while. And then we look at precious metals, and gold had a bounce, but it looks like it failed because it got hit really hard last week. And if you look at the long-term trend for precious metals here, the long-term trend is clearly down. Right? You had the big move down in 2016, a long consolidation, the breakdown, and it looked like we were turning up, but the strong dollar is just too much here for gold and silver, and they're turning back down. And the PPO has been negative. So, I saw a bullish chart for gold short term on the dailies, but on the weeklies and the monthlies, gold does not look bullish. And then finally, we get to the softs here. All right. And the softs are clearly in a downtrend. A nice big 3-week rally, but we're giving it back already, and we need to get some follow through above 40 to turn it around in softs. While I'm at it, I'll just show a little chart for the dollar here. Look at that big move up, a little pullback correction, and then an outside reversal and a move to new highs. And here's the weekly for gold. All right, we were firming here. We got that big surge and the little breakout there, stalled for 3 weeks, and we're now coming back down. So it looks like this breakout is failing for gold. And that concludes this edition of On Trend. Thanks very much for tuning in, and remember to stay on the right side of the trend.